I'm Olivia, and this is American Dream Route. If you have a pension, the IRS treats you very differently than every other retiree in America. Different from someone with a 401k, different from someone relying only on Social Security, different from someone whose retirement income comes mainly from a brokerage account. And the truth is, most people, including plenty of accountants, don't fully understand what that difference means for your tax bill. Here's something worth sitting with for a moment. Only 14% of private sector workers still have access to a traditional pension, but 86% of state and local government workers do. So if you're watching this and a pension is in your future, you're part of a relatively small, very specific group. The usual retirement advice you hear everywhere, the standard rules of thumb in retirement books, the 4% rule, the typical withdrawal order, almost none of it was designed with you in mind. In this video, I'm going to walk you through 6 ways the IRS treats pension recipients differently than everyone else, and why almost nobody is talking about them. By the time you finish watching, you'll understand exactly how your pension changes the math around Social Security taxation, Roth conversions, Medicare premiums, state taxes, required minimum distributions, and the lump sum versus monthly pension decision that so many people get wrong. But before we dive in, I want to ask you something. Drop a comment right now and tell me just one thing. Do you have a pension coming, or are you already collecting one? Yes or no? I'm asking because your answers will shape what I create next. If most of you are still working and planning ahead, I'll make one kind of video. If most of you are already receiving your pension and trying to make the best of what you've got, I'll make something different. So take 2 seconds and leave a yes or no in the comments. I read every single one. Before we go any further, I need to be crystal clear. I'm not a lawyer, I'm not a CPA, I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always check with a qualified tax professional about your own situation. My name is Olivia, and if this is your first time watching my channel, American Dream Route is made for one specific audience: retirees and pre-retirees over 60 who want a clear, plain English understanding of how the IRS actually operates in retirement. Not the simplified version you heard in an HR meeting, not the confident opinions your neighbor shares at the kitchen table, the real version with real numbers. If that sounds like you, hit subscribe right now, because next week I'm releasing what may be one of the most important videos I've ever posted here. Let's start with the thing that catches pension holders off guard more than anything else. The first way the IRS treats you differently is that, in most cases, your pension is taxed as fully taxable ordinary income. A lot of people don't realize that. They assume that because they contributed to the pension during their working years, some portion of the money coming back to them will be tax-free. For the vast majority of pensions, that's not how it works. If your pension was funded entirely with pre-tax employer contributions, every dollar you receive in retirement is taxed as ordinary income at your federal marginal tax rate, not at capital gains rates, not at some special pension rate. Ordinary income, the same way wages are taxed. If you personally made after-tax contributions to your pension while you were working, you may be able to recover a small portion of each payment tax-free using the simplified method. But for most private pensions and most public sector pensions, the tax-free portion is often less than 10% of each payment. Here's what that looks like in real life. Let's say you're receiving $36,000 a year from your pension. If you're mentally treating that money like Social Security, something that just shows up, you may be in for an unpleasant surprise. At a 12% federal tax bracket, about $4,300 of that goes to the IRS. At 22%, it's closer to $7,900. And that doesn't even include state taxes yet. Which brings us to the second way the IRS treats pension income differently. Where you live matters far more for pension income than it does for almost any other kind of retirement income. Most retirees think about state taxes mainly through the lens of whether their state tax is Social Security. 9 states still do. But pension income is handled very differently from Social Security at the state level, and the differences are huge. Pennsylvania, for example, doesn't tax pension income at all. 0. If you live in Pennsylvania and receive a pension, the state takes nothing from it. Illinois is the same. Mississippi is the same. New Hampshire has no income tax at all. Florida, Texas, Tennessee, and Nevada also have no state income tax. Now compare that with California, where pension income is taxed as ordinary income at the state's regular rates, which can reach 9.3% depending on your bracket. Or New York, where the first $20,000 of pension income is exempt for people over age 59-12, but everything above that is fully taxed at the state level. Or Minnesota, which still taxes a meaningful portion of pension income with only limited exemptions. If you're collecting $40,000 a year from a pension and you live in California instead of Pennsylvania, you could be paying about $3,700 more per year in state taxes simply because of where you've chosen to retire. Over a 25-year retirement, that adds up to more than $90,000. Same pension, same lifestyle, different state, $90,000 difference. The third way the IRS treats pension holders differently is how your pension affects the taxation of your Social Security benefits, compared with someone who doesn't have a pension. This is one of the most misunderstood parts of retirement tax planning. The IRS uses something called provisional income to decide how much of your Social Security benefit is taxable. Provisional income is calculated as your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. If you're a single filer and your provisional income is below $25,000, none of your Social Security is taxed. Between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Here's what almost nobody points out. Pension income counts in full toward your provisional income. No exemption, no offset. So if you're receiving $30,000 a year from a pension, your provisional income starts at $30,000 before you withdraw a single dollar from an IRA, before you collect any Social Security, and before you earn a penny of interest. That means pension holders are, in practical terms, almost automatically pushed into the 85% Social Security taxation zone. If you have a $30,000 pension and collect $24,000 in Social Security, your provisional income is $42,000, even with zero IRA withdrawals. That's well above the $34,000 threshold. As a result, 85% of your Social Security becomes taxable. That's $20,400 of additional taxable income coming from your benefit alone. Now compare that with someone who has no pension but receives the same $24,000 Social Security benefit and pulls $30,000 from an IRA. They have flexibility. They can reduce IRA withdrawals in a given year. They can pursue strategic Roth conversions. They can actively manage their provisional income. If you have a pension, you usually don't have that flexibility. The pension pays you the same amount every month whether you want it to or not. And those provisional income thresholds were set in 1983 and 1993. They've never been adjusted for inflation. Pension holders cross them almost by default. Quick pause here. I want you to drop another comment. Tell me, did you know your pension was pushing your Social Security into the 85% taxable zone? Yes or no? I'm genuinely curious how many people watching this had no idea. Your comments help me decide what to teach next, so please take a moment to answer. The fourth way the IRS treats pension holders differently is in how Roth conversions work, and this one surprises people. A Roth conversion happens when you move money from a traditional IRA into a Roth IRA, paying tax on that amount now so the money can grow tax-free in the future and won't be subject to required minimum distributions during your lifetime. For most retirees, the best time to do conversions is during the gap years between retirement and age 73, when required minimum distributions, RMDs, begin. Those years are often the lowest income years of retirement. But pension holders usually don't have those low income gap years. The pension starts paying, the income is fixed, and there isn't a clean low income window to take advantage of. So the conventional Roth conversion playbook can look like it doesn't apply to you. If your pension already keeps you in a higher tax bracket, why convert at 22% or 24% when other retirees can convert at 12%? Here's the counterintuitive truth. For pension holders, Roth conversions can still make a lot of sense, but for a different reason. It's not because you're converting at a low tax rate. It's because your pension has already locked you into a relatively high effective marginal tax rate for the rest of your life, and the future is likely to be even more expensive from a tax standpoint. When you reach age 73 and RMDs kick in, those required withdrawals stack on top of your pension income. Your pension doesn't stop, your Social Security doesn't stop, and your RMDs are calculated from your traditional IRA balance, increasing as a percentage of that account as you get older. By age 80, you might be required to withdraw around 7% of your IRA balance each year, whether you need the money or not. By age 90, that figure can climb above 12%. If you have a $30,000 pension, $24,000 in Social Security, and a $400,000 traditional IRA, your RMDs at age 73 might start around $15,000. By age 80, with normal growth, they could be over $25,000. Add it all together, and you could easily be looking at $60,000 to $70,000 of fully taxable income every year. Much of it income you're forced to take whether it fits your spending needs or not. That's the trap. For pension holders, the goal of Roth conversions often isn't to find a low bracket. It's to reduce the size of the traditional IRA before RMDs make the tax picture harder to manage. Converting $20,000 a year in your 60s at 22% might feel uncomfortable in the moment, but converting $40,000 a year in your 80s at the same rate on top of a full pension and fully taxable Social Security is almost always worse. In many cases, the math favors paying the tax now, while you still have more control over the timing. The fifth way the IRS treats pension holders differently shows up in Medicare IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's an extra charge added to Medicare Part B and Part D premiums when your income goes above certain thresholds. For a single filer in 2026, if your modified adjusted gross income, MAGI, from 2 years earlier was above $109,000, you'll pay an IRMAA surcharge on top of your standard premium. For married couples filing jointly, that threshold is $218,000. The standard Part B premium in 2026 is $164.90 per month. With the first IRMAA tier, that number jumps meaningfully. At the higher tiers, premiums can exceed $600 per month per person. Here's why pension holders need to pay close attention. Your pension is fixed income you can't turn off. It contributes to your MAGI every year. If you also have a substantial 401k or IRA, and you decide to do a Roth conversion in a given year, that conversion gets layered on top of your pension and Social Security income. It's surprisingly easy for a pension recipient doing a normal-sized Roth conversion to accidentally cross an IRMAA threshold, and the 2-year look-back is what makes this so risky. The IRS uses your income from 2 years ago to set today's Medicare premiums. So a Roth conversion you do in 2026 can increase your Medicare premiums in 2028 by hundreds or even thousands of dollars per year for 2 consecutive years. Pension holders need to plan conversions with one eye on their federal tax bracket and the other eye on the IRMAA tier they're about to cross. Most accountants don't automatically run that second calculation, and most retirees don't even realize it's something they need to ask about. If you're a married couple with combined income from a pension and Social Security totaling $190,000, and you're thinking about a $40,000 Roth conversion, you need to know whether that move pushes you across an IRMAA threshold and potentially costs you an extra $2,000 to $3,000 per year in Medicare premiums for 2 years. That's real money on top of the tax you'll owe on the conversion itself. The strategy may still make sense, but only if you understand the full cost. Now, before we get to the 6th and biggest point, I want to do something. If you've made it this far, you're exactly the kind of viewer American Dream Route is built for. Hit the like button. It takes 1 second, and it helps YouTube show this video to more pension holders who need to see it. And if you haven't subscribed yet, please do it now. I publish videos like this every week, and I don't want you to miss what's coming next. The 6th and biggest way the IRS treats pension holders differently is in how your lump sum versus monthly pension decision affects your taxes for the rest of your life. When you retire from a job that offers a pension, you're often given a choice. You can take a guaranteed monthly payment for the rest of your life, often with a survivor benefit option for your spouse, or you can take a lump sum, roll it into an IRA, and manage the money yourself. Most financial content treats this like a pure math problem. What's the better rate of return? Will you live long enough to break even on the monthly payments? But the IRS side of this decision rarely gets the attention it deserves, and it can be enormous. If you take the monthly pension, every dollar you receive is fully taxable as ordinary income every year for as long as you live. That income stream is locked in. You can't defer it. You can't accelerate it. You can't restructure it. It just keeps coming year after year, fully taxable. If you take the lump sum and roll it into a traditional IRA, you've essentially bought yourself a great deal of tax flexibility. You decide when to withdraw money. You decide how much to withdraw. You decide which years to do Roth conversions. You can manage your provisional income. You can stay below IRMA thresholds in lower spending years. You can accelerate withdrawals in years when you have higher deductions. In other words, you can do all the things pension recipients usually can't do because their income is fixed. But, and this is critical, the lump sum is only better if you actually use that flexibility. If you take the lump sum, roll it into an IRA, and then simply take steady monthly distributions in the same way the pension would have paid you, you've given up the guaranteed income and taken on investment risk, longevity risk, and management responsibility without capturing the tax timing benefits that made the lump sum appealing in the first place. The lump sum decision isn't really about investment returns. It's about whether you're willing and able to actively manage the tax timing of every dollar for the rest of your life. If the answer is yes, the lump sum can be incredibly valuable. If you're going to set it on autopilot and withdraw the same amount every month, the pension is almost certainly the better choice because it removes investment risk and longevity risk, and the tax outcome ends up looking very similar to what you'd get from a lump sum that you never strategically manage. There's also a hybrid option that almost nobody talks about. Some pension plans allow you to take a partial lump sum and a partial monthly payment. In my view, this is an option almost every pension holder should seriously evaluate. You can take enough monthly income to cover your fixed expenses: housing, utilities, food, insurance, and so on. Then you can take the rest as a lump sum, giving yourself tax flexibility for everything else. You get the security of guaranteed income for your needs and the tax control for your wants. Most people don't even realize this option exists, so it's worth asking your pension administrator directly. Now let's bring all 6 points together, because they don't operate in isolation. They interact in ways that make pension planning fundamentally different from non-pension planning. Your pension is, in most cases, fully taxable as ordinary income, so federal taxes hit you harder than many people expect. Your state of residence can dramatically change the after-tax value of that pension, in some cases by tens of thousands of dollars over the course of retirement. Your pension almost automatically pushes your Social Security into the 85% taxable zone, with very few exceptions. Your Roth conversion strategy needs to look different because you don't have low-income gap years, but you also face a bigger RMD problem down the road if you do nothing. Your Medicare IRMAA exposure is constant because your pension sets a floor under your income every year and any conversion stacks on top of it. And your lump sum versus monthly decision should be driven primarily by whether you'll actively manage tax timing, not by trying to outguess investment returns. Here's the practical reality. If you're a pension holder, the standard retirement playbook doesn't really fit you. The 4% rule wasn't written for someone whose guaranteed income already covers most of their expenses. The standard Roth conversion ladder wasn't designed for someone whose income floor is permanently elevated. The default Medicare premium calculator doesn't warn you how easily you can cross IRMA thresholds, and most people comparing state taxes focus on Social Security, not pension income. You need a different framework. At the heart of that framework is something financial professionals often call asset-liability matching. Match your fixed expenses: housing, utilities, food, insurance, basic transportation with your fixed guaranteed income, your pension, and Social Security. If your guaranteed income covers most of your fixed expenses, your investment portfolio is freed up to serve a different purpose. It doesn't need to be ultra-conservative. It doesn't need to be structured mainly to generate income. It can be positioned for growth, for legacy goals, for opportunity, because your day-to-day survival is already secured by the pension and Social Security. Let me give you a concrete example so you can see this in action. Imagine a couple, both 66. The husband retired last year from a state government job. His pension pays $36,000 a year with a joint and survivor option. Their combined Social Security is $40,000 a year. When they sat down and totaled their fixed expenses, housing, utilities, food, insurance, basic transportation, healthcare premiums, they came to $68,000 a year. So their guaranteed income is $76,000 and their fixed expenses are $68,000. That leaves them with an $8,000 cushion before they ever need to touch a single dollar from their investments. That changes everything. They also have $450,000 in a traditional 401k that they've been holding in a target date fund, 60% stocks and 40% bonds, the default middle-of-the-road approach. But they don't actually need that money to survive. Their pension and Social Security already cover their fixed lifestyle. The 401k is there for travel, gifts to grandchildren, the occasional new car, and a buffer for potential long-term care costs. Those are wants, not needs. And money earmarked for wants can often tolerate more risk, because if the market drops 30%, they can postpone a vacation. They're not at risk of losing their home. For this couple, the right answer may be to be more aggressive in the 401k, not more conservative, maybe 80% stocks and 20% bonds, or something along those lines. Their pension is already functioning like a large bond allocation in their overall financial picture. Adding more bonds in the 401k can end up being double counting, and it can mean leaving long-term growth on the table for a layer of safety they've already built in elsewhere. Now layer on the tax strategy. They're 66, with 7 years until RMDs begin at 73. During those 7 years, they should seriously consider doing strategic Roth conversions every year. Not because they have low-income gap years, they don't, but because their RMDs at age 73 on a $450,000 account that compounds for 7 more years are likely to be substantial. If that account grows to $700,000 by age 73, the first RMD could be more than $26,000 fully taxable on top of their pension and Social Security. Converting $25,000 a year for 7 years at 22% might cost them about $8,500 in cumulative federal tax over that period. But doing so could remove nearly $200,000 from the future RMD pile over a 30-year retirement. That kind of move can save them well into 6 figures over time. The conversion may feel painful in year 1. By year 10, it's often invisible. And by age 85, it can feel like one of the smartest decisions they ever made. This is where a lot of pension holders get it wrong. They have guaranteed income covering their needs, and yet they keep their 401k in conservative, balanced funds as if that account is still their safety net. It's not. The pension is the safety net. The 401k is the opportunity fund. Because pension holders aren't relying on their investment portfolio to cover basic living expenses, they can often afford to take more investment risk than retirees without pensions. There's one more piece of this puzzle that almost nobody gets right, and it involves your spouse. When you elected your pension, you likely had a choice between single life, which pays more per month but stops the day you die, and joint and survivor, which pays less per month but continues to your spouse for the rest of their life. Most people make this decision based purely on the monthly payment difference. They choose the higher single life payment because it looks like the better deal on paper. But you need to run the numbers on what happens to the surviving spouse. When one spouse dies, household expenses don't drop by half. In most cases, they drop by only about 20% to 25%. The mortgage is often the same. The utilities are mostly the same. The insurance is mostly the same. But the household loses one Social Security check entirely. And if you elected a single life pension, the entire pension stops too. That can leave the surviving spouse with roughly 75% of the previous expenses and often less than 50% of the previous guaranteed income. That gap is what financially destabilizes people. I've seen widows in their late 70s who were perfectly comfortable while their husband was alive, and within 5 years of his death, they were pulling large, unplanned withdrawals from a 401k that was never sized to support just one person. Choosing single life pension benefits to maximize monthly income while both spouses are alive is one of the most consequential mistakes I see pension holders make, and it's almost always done without modeling the survivor scenario. If you're married and haven't retired yet, do this exercise. Take your current fixed expenses and subtract 25%. That's your surviving spouse's likely expense floor. Then look at what guaranteed income would remain if you died first. just the surviving spouse's Social Security check plus whatever pension survivor benefit you elected. If that number falls well below the expense floor, the joint and survivor election is almost certainly the right choice. Even though the monthly payment is lower while you're both alive, you're essentially buying insurance for the most financially vulnerable years of your spouse's life. There's also the inflation issue that pension holders need to take seriously. Most private sector pensions and many public sector pensions do not include a cost of living adjustment. The $36,000 a year you receive in year 1 is the same $36,000 in year 10, year 20, and year 30. But the cost of everything around you keeps rising. At 3% annual inflation, $36,000 of today's purchasing power is worth roughly $27,000 in 10 years and about $20,000 in 20 years. That erosion happens gradually, so it doesn't feel dramatic year to year. But by retirement, years 15 to 20, the gap between what your pension pays and what you actually need to maintain the same lifestyle can become enormous. That's why your 401k or IRA balance matters so much, even if your pension currently covers your expenses. Your investment portfolio isn't just there for extras, it's also your inflation defense, gradually bridging the widening gap between fixed pension income and rising real-world costs. Social Security does include cost of living adjustments. Most pensions don't. So the longer you live, the more your overall guaranteed income shifts away from being pension dominant and toward being Social Security dominant in real terms. Plan for that. Don't assume the budget you build at age 65 will work at age 80 without meaningful inflation-adjusted withdrawals from somewhere else. Once you understand all of this, your decisions start to change. Roth conversions become a tool for shrinking the IRA before RMDs make the tax picture harder. Strategic withdrawals become about managing IRMAA tiers, not about blindly following a 4% rule. State residency becomes a real financial decision because the math for pension holders is different than it is for everyone else. And the lump sum versus monthly pension choice becomes less about investment returns and more about whether you'll actively manage tax timing for the rest of your life. One last thing before I wrap up. If you have a pension, the most expensive mistake I see people make is doing nothing. They retire, they start collecting the pension, and they assume the tax side of things will somehow take care of itself. 10 years later, they're paying tens of thousands of dollars in taxes that a few early decisions could have prevented. The IRS doesn't send you a friendly note explaining how much you're overpaying. They're perfectly content to keep collecting. So here's what I want you to do. First, if you're still working, find out exactly what pension choices you actually have. Single life, joint and survivor, lump sum, partial lump sum.